Right now, somewhere in the world, someone just lost everything. Not because they are stupid, not because they did not work hard, but because they entered at the wrong time. They analyzed correctly. They identified the direction. They had discipline. They managed risk. But their timing was off by minutes, sometimes seconds. And the market does not forgive bad timing. It does not matter how right you are if you are right at the wrong time. We have all experienced this multiple times. Our bias is correct, our analysis is correct, but we lose money because our timing is wrong. Today, I'm going to show you why timing is everything, and why most traders never learn it. Let's begin. Fallacy 1. Analysis was enough. You studied the chart, you drew the levels, you identified your support and resistance, you saw the pattern, you concluded the market is going up, and you were right. The market went up, but you still lost money. How? Because being right about direction does not mean you make money. The market does not pay you for being right. It pays you for being right at the right time. And most traders confuse the two. Meet Daniel. He spent hours analyzing, saw a clear bullish setup, strong support, momentum building. He entered. Price immediately dropped, hit his stop, then reversed and went exactly where he predicted. He was right, but his timing was wrong. He entered too early, before the final shakeout, before the last wave of sellers capitulated. His analysis was perfect. His timing was not. And in trading, timing beats analysis every time. Fallacy 2. The buy low, sell high cliche. This phrase sounds smart, and it is killing traders. Why? Because low and high are relative. The market does not mark tops and bottoms for you. What looks low can go lower. What looks high can go higher. And if you base your timing on this idea, you will catch falling knives and sell too early forever. Meet Sarah. She sees a stock at $50. It was $80 last month. She thinks this is low, buys at 50. It drops to 40. She thinks 40 is even better, buys more, drops to 30. Now she is down badly, averaging into a falling position, all because she thought 50 was low. But low compared to what? The past. The market does not care about the past. It cares about now. And now the trend is down. Her timing was based on a fallacy. And fallacies do not make money. How professionals think. Markets move in 4 phases: accumulation, movement, crowd participation, exhaustion. Amateurs enter at phase 3, when everyone is talking about it, when the move is obvious, when everyone has started talking, when momentum is screaming. Professionals are already looking to exit at phase 3. They entered at phase 1, quietly, when nobody cared, when price was boring, when the fear index was high, when nobody was talking about it. That is timing. Not entering when it feels right, entering when it does not. Meet James, professional trader. He watches a stock consolidate for weeks, tight range, low volume, boring. Nobody talking about it. He enters small. Accumulation phase, price starts moving. Phase 2, he adds to position. Then the breakout happens. Phase 3, retail floods in, news articles appear. Everyone buying. James starts scaling out. By the time amateurs are convinced, he is gone. They bought his shares. At the top, he bought at the bottom. Not because he predicted the top, but because he understood phases and timed his entry and exit accordingly. Trading is all about timing. We have all lost money from correct analysis because we entered at the wrong time. When you trade, how many times have you thought, what are retail traders doing right now? What are they thinking and seeing right now? How are they feeling? Fear. Fear of missing out. Greed. What is dominant right now? Where fear is dominant, I approach long setups with appetite, because when most people's hands do not go to longs, it makes no difference to me. If war breaks out in the Middle East and directs people toward fear and selling, I want to long. And when deciding my bias for the next week, I consider not just the chart, but this as well. Timing is everything. What is the perfect entry point? It is not when momentum is strongest. It is when character changes. The moment the market turns. When sellers exhaust. When volume speaks. When nobody is talking yet. The perfect entry is invisible. It does not feel good. It feels uncertain. And that is exactly why it works. Because if it felt good, everyone would take it. And when everyone takes it, it is already too late. If doubt and fear are dominant, we are close to the perfect entry. If everyone is still rushing to buy and looking long, the bottom has not come yet. Meet Alex. He waits for the shakeout. Price drops hard. Panic selling. Volume spikes. Everyone is scared. Then buying comes in. Small at first, then consistent. Sellers exhausted. Character changed. Alex enters, not at the bottom tick, but after the bottom is confirmed, after the shift. His timing is not based on prediction, it is based on observation. And observation-based timing is superior to prediction-based timing. Timing alone means nothing, but without timing, strategy also means nothing. Exit, the real battlefield. Everyone obsesses over entry, but exit determines the money. You can have perfect entry timing and destroy your profit with terrible exit timing. There are 3 types of exits: stop loss, target, trailing. Stop. All 3 must be planned before entry. If your exit is not planned, it will be emotional, and emotional exits lose money. You must know your exit point before everything even starts. Meet Morgan. Perfect entry. Trade moves 50 pips in profit. No exit plan. Greed whispers, hold for more. Reversal comes. 50 pips becomes negative 20. Exit in panic or opposite scenario. Up 10 pips. Fear whispers, take it. Exits. Trade runs to 80, left 70 on the table. Both scenarios are exit timing failures. The solution is simple. Plan exit before entry. If this level hits, I exit. If this time passes, I exit. No emotion, just plan. Exit timing is as critical as entry timing, maybe more. This way, the emotional load you will experience during the trade is minimized. Because your stop point and exit point are predetermined and one of them will work, in this case, all you have to do is wait. But if you determine your exit point specially for each trade, you will constantly monitor the trade and look for the most optimal exit point. This will consume you psychologically, and even if the trade ends successfully, you will experience unnecessary mental fatigue. Knowing your exit before entry takes you much further, and you should test where this exit point should be specifically for your strategy by backtesting. And when you find the most likely exits, you can always look for them. For example, you recorded the last 100 trades of your strategy, and you noted where each went the most. One of your trades gave 1 to 2, another 1 to 5, but you saw all of them had a common point. 78 of your 100 trades went above 1 to 2.5. After encountering such a statistic, taking a trade at 1 to 2 would not make sense. Structuring each of your trades to exit at 1 to 2.5 will be the most logical choice. Market rhythm. Every market has a pulse, trending or ranging, fast or slow, volatile or calm, and your timing must match the rhythm. Trading a breakout strategy in a ranging market is bad timing. Trading a mean reversion strategy in a trending market is bad timing. Before you time your entry, identify the rhythm. Then time accordingly. If you were going to scalp NASDAQ after 9:30, you would not choose a strategy where each confirmation takes at least 5 minutes to establish, right? Because after 9:30 it is fast and you must keep up with the speed. On the other hand, Asian range generally goes sideways and we do not see much expansion. Chasing expansion trades within Asian range is foolish, and generally range-bound strategies can work better. Meet Jordan. Scalper. Loves quick in and out. Works great in ranging markets. Then market trends. Strong momentum. His scalps keep getting stopped out because he is trading range rhythm in a trend environment. Timing mismatch. If he just paused and asked what is the market rhythm right now, he would see the trend and either switch strategy or sit out. But he does not. He forces his timing into the wrong rhythm, and the market punishes that. We do not have the luxury of forcing anything. We are the ones who must adapt, not the market. The market provides us with data, and we interpret it. We must interpret this data as neutrally as possible, away from our emotions, and act accordingly. The most dangerous moment. When you need to make money. Bills are due. You lost last week. You need to recover. And this psychological pressure creates the worst timing decisions. You do not enter from strength. You enter from fear, from desperation. And desperate timing is bad timing. Always. If you are in such a psychology, everything going wrong is inevitable. You can somehow close even a day that seems certain for your strategy to make money at a loss. I know what I am saying does not surprise you because you have experienced this too. I have experienced it countless times. Whenever you sit at the screen needy and you need to make money, that is when everything somehow finds a way to go wrong. Even if you make money, by the end of the day, you will definitely have given it back. Trading this way, unfortunately, makes failure inevitable. Meet Riley, lost 3 trades in a row, down for the month. Rent is due next week, pressure building. A mediocre setup appears. Normally he would pass, but today, he needs the money. He enters. Timing is off. Setup is weak, stop hits. Now down even more. The pressure increased. Next trade even more desperate. Worse timing. Another loss. Spiral. The moment you need to make money is the exact moment you should not trade, because need corrupts timing. The market catches you from your weak spot and uses it to take the remaining money in your pocket as well. The market is a master at hunting the psychologically needy and weak. It makes you see setups that are not there. Enter before confirmation. Hold too long, hoping for recovery. All timing errors. Driven by need. Never sit at that screen feeling needy. Please constantly remind yourself of this. It is as normal as anything that you need money, but if you reflect this into your trading, you cannot be successful. You will force setups that do not exist. You will chase the impossible and eventually lose. Patience. The highest return investment. Being in trades constantly does not mean constantly making money. In fact, most of the time it means constantly losing money. The best traders make the fewest trades. They wait. They watch. They let bad setups pass. They just wait until opportunities emerge. They sit through dead markets. They do not force action, because they understand that timing is about waiting for the right moment, not creating moments. For example, this week started with incredible fear. I went on Twitter and saw the fear and reluctance in people, and frankly, I was very surprised by this. Because despite all the war developments, I was looking at all this with calmness instead of being impulsive as always. Markets opened, and all I saw was that a week where Nasdaq would go up had started. Moreover, nobody's hand was going to longs, and frankly, I thought a long opportunity I'd been waiting for a long time had come to my feet. Everything seemed appropriate for this, and I took a swing long position, and I say this openly from my heart. I may be wrong in this analysis, of course, but all conditions are telling me that Nasdaq will go up. The chart is bullish for me, and now people's fear and reluctance are also saying the time has come. And on top of all this, my bullish setup emerged, and I took my swing long and will hold it until new highs. We will see what happens, but I wanted to give this as a real example because it is all happening before our eyes. While people had anxiety and fears, I had no emotion. Taking action was not difficult, on the contrary, it was like always. War drums ringing in the Middle East did not make my hand tremble while opening the position. Why would it tremble? I manage my risk and know what I am doing. Meet Taylor. Used to trade 10 times a day, always in the market, mostly losing. Frustrated. Then shifted. Started waiting. Watched for specific conditions. Some days, no trades. Some days, 1 trade. Trade count dropped 70%. Profitability increased 40%. Not because she got smarter, because her timing improved. She stopped forcing. Started waiting. Waiting is active, not passive. You are hunting, watching, ready, but not shooting until the target is clear. That is timing mastery. The technology fallacy. Traders think if I find the right indicator, the system will do it for me. Algorithmic thinking, but algorithms cannot feel regime changes. They cannot sense when market character shifts. Human judgment is still central, and human judgment is about timing, reading context, feeling momentum, sensing exhaustion. These are timing skills, not automated, developed through experience. Do you know how to smell the air? And yes, this is not only important for swing trading, it is also valid for scalping. An instant movement occurs, let's say a sudden drop happened. There is a terrible drop candle on the 1-minute chart. Do you hear the sounds? Are people feeling what right now in your mind? What is happening right now? The day you manage to answer this question is one of the days everything will change. And if you integrate this into your system and edge, you will get incredible results. Try to catch the smell. Who is feeling what right now? Whose hand is trembling? Who wants to act greedily? Sometimes you can even make judgments by catching your own emotions, and this gives you a big clue. For example, today, even for a very brief moment, I questioned whether the market might be bearish. And this brief moment came to me as confirmation that the market had turned long. Because if even I question my bias as bearish, what state are people in? That is why I stayed loyal to my long, and I see my brief questioning state as extra confirmation. I hope you understand what I'm saying. Meet Sam. Spent years building indicators, complex systems, automated entries. Worked sometimes. Failed often. Why? Because markets change. What worked last month does not work this month. The algorithm does not know that. It keeps executing the same timing rules in different conditions. Sam finally realized. Timing requires adaptation, judgment, feel. Things algorithms do not have. He simplified, went manual, focused on reading market character. Timing improved, results improved. Mental state equals timing tool. Trading when tired is bad timing. Trading when angry is bad timing. Trading when distracted is bad timing. Your mental state affects your ability to time entries and exits. Know your performance window. Trade during it, sit out outside it. This is also a timing decision. Meet Casey. Trades best in the morning, sharp, focused, clear. Afternoon she gets tired. Decision quality drops. She used to trade all day. Morning trades profitable. Afternoon trades gave it back. She realized her performance window is morning only. Now she only trades mornings. Same strategy. Better timing. Why? Because she timed her trading to her mental state, not just to market conditions. Specialization. 20 stocks. 4 strategies. 3 time frames. 0 depth in any. Timing mastery requires focus. 1 market, 1 strategy, 1 time frame. Over years, real intuition develops. You start feeling the timing. Not thinking it, feeling it. That only comes from deep specialization. Meet Jordan. Traded everything. Forex, stocks, crypto, commodities. Different strategies for each. Never mastered timing in any. Always surface level. Then he picked one. S&P 500 futures. 1 market, 1 strategy. Breakouts, 1 time frame. 15-minute, focused for 2 years. Now he feels when the timing is right, does not need to overthink. The pattern, the volume, the momentum. He just knows. That is what specialization does. It turns timing from analysis into instinct. The learning process. First, watch. Do not trade, just observe. See how setups develop, how they fail, how timing works. Second, trade small. Real money but tiny risk. Test your timing. Third, journal every trade, entry time, exit time, why you entered when you did. Fourth, review. See patterns in your timing, where you enter too early, too late. Fifth, adjust. Improve timing incrementally. No shortcuts. This is the process. Meet Harper, new trader. Wanted to jump in, make money fast. Instead, she watched for 3 months. No trades, just observation. Then started with $50 risk per trade. Tiny. Tested timing. Journaled everything. After 6 months, reviewed. Saw she always entered too early, impatient, adjusted. Started waiting for full confirmation. Timing improved. After 1 year, she was profitable. Not because she found a magic strategy, but because she learned timing. The slow way, the only way, the close. Timing is not just reading charts, it is patience, discipline, emotional control, adaptation, mental state awareness, specialization. If you learn these, you will make money with any strategy. If you do not learn these, no strategy will save you. Because strategies do not make money. Traders with good timing make money. And good timing is not a talent, it is a skill. Built through observation, repetition, discipline, patience. The market will teach you timing if you let it, but only if you stop forcing, stop rushing, stop needing, and start watching, waiting, feeling. That is when timing clicks. That is when trading works. Not before.